All right, welcome back. Patrick Badalato. Wanted to jump into our last conversation for now, actually, because there's always more we can do and add on with ratios. I want to talk about liquidity and some general measures of capital structure, and then kind of bring together some broader measures of looking at return on capital defined differently in different ways. By no means is this a full conversation. These, like all the others, can get more in depth, much more complex, but just a general introduction of what we want to do with each of these things. So first, liquidity. Why do we care about liquidity? Well, a company's ability to pay its bills, especially if it's struggling, is extremely important. And in many ways, we don't want to overstate, like, the longer run prospects of the business if we can't make good on our payments in the next month or 2 months or 3 months. So we, alongside our broader assessments of the business and the potential and everything else, we just want to make sure we're checking in and have kind of an eye on liquidity. Also, if you're a provider of debt capital, you probably care even a little bit more about liquidity, because at the end of the day, you are not really interested in the upside of the company, how well they perform in terms of long run revenue growth. You're really interested in, am I going to get paid back? And we'll show that in a second with the interest coverage ratios. But let's get into this conversation. Is there one way to measure liquidity? No. What are we really using here? I would argue it's a combination of all three financial statements. And this is not a complete list of ratios for that reason. Net working capital, that would be our assets minus our liabilities. And the argument there is assets are things that are cash or might turn to cash, and liabilities, current assets, current liabilities. Current liabilities are the things that we're going to have to pay in cash, like within a year. Current assets, generally speaking, are things that we would expect to be able to have in cash or turn into cash within a year. If we compare the things that are liquid on a balance sheet, current assets are relatively liquid, we can compare that to the obligations, future sacrifices, liabilities on the balance sheet to get a general idea. So I'm not trying to give you, it should be this, but if you think about it, if your assets are greater than your liabilities, that's one measure of looking at liquidity to say that, okay, I think we at a very quick view, you could say, I think we'll be able to cover our bills as they come due. Current ratio is really that same thing, except we're going to change it to make it a fraction where we have assets in the numerator and the current operating assets on the numerator and current liabilities on the denominator. And that's just looking at them in proportion to each other. So really the same idea as net working capital. Generally speaking, net working capital, we're talking about the dollar amount, right? The difference in the dollar amount, and current ratio, we're usually looking at a proportion, the assets divided by our liabilities. Quick ratio, very similar idea with one exception. We remove from that inventory, but really, actually, I want to be clear, any other. The best way to do the current ratio, commonly we just talk about, we remove inventory because it might take longer to sell and then we have to collect. But really, the quick ratio should just be in the numerator, the assets that we feel really good about turning to cash in a relatively quick period. And I would, in many ways, that's likely less than a month or less than a month. So things that you truly can get access to cash very quickly. The reason we exclude inventory is that it might still take more time to turn inventory to cash. But the same should be applied to any other current asset. Look through your current assets and say, do I expect, and use inventory as a general guide because inventory is not included in the quick ratio. Look at it and say, do I expect to be able to turn this into cash relatively quickly without without more than one step? AR, I just have to collect. I have to collect. That's one step. Cash, it already is cash. Inventory, I have to sell. Then I have to collect. That's our reason for excluding it. So look at your current assets and say, are there any that take more than one step to turn into cash? Then you might want to exclude those. And we leave our denominator, liabilities, constant. So naturally, the quick ratio would be less than or equal to the current ratio. It's a more strict or more conservative way of looking at liquidity. And we have interest coverage ratios, particularly relevant in a financial situation where a lender is involved. And these might be a part of debt covenants, the rules that lenders set up that you have to follow. And what is this doing is different ways of measuring this. At times we use earnings, we use adjusted earnings, we use cash flows in our denominator. I said that wrong, sorry, our numerator. And we divide that into our expected interest expense in the denominator. So interest expense in the denominator is like what we have to pay based on the amount of money we've borrowed in the past. Our interest expense is the upcoming cash obligation or the current cash obligation. And what we put in the numerator, whether it's cash flows, adjusted cash flows, income, operating income, adjusted operating income, et cetera, people do this different ways. And it just varies in degree of what do we want to leave in or what do we want to extract. But at the end of the day, what we're trying to do here in a general level, and I cover these more in the Excel sheet, is just look at, do we have, how many times could we cover our interest at like the basic level? And why is that one useful perspective to consider? Well, if we don't pay our interest to our providers of debt capital, worse things can happen. They may require we pay our full debt. They may not lend to us anymore. We may violate one of the rules that they set up in the debt covenant. So like at a minimum level of staying in business, we have to cover really all of our expenses, but we certainly have to be able to cover our interest expense after we cover expenses like cost of goods sold and payroll and everything else. So different ways of measuring interest coverage ratio, a basic way of assessing how many times could we pay off our debt, our interest, and therefore at a basic level, are we generating enough cash on a recurring basis to have no issues with paying our interest as it comes due? Just because that fact is yes doesn't mean we're a great company. That's a good bare minimum of getting by. All right. Switch gears a little bit here. I want to talk about other ways of looking at capital structure. So we can look at debt to total assets, and there's different ways of measuring capital structure, and these aren't the only ways, but the general idea here is, well, if you look at debt as a proportion of total assets, you'd be saying like, what proportion of my total assets have I financed with debt? And more debt is generally seen as like higher financial leverage. I'm not in any way saying that's good or bad, but it's certainly worth understanding. So when you're looking at a company, it's worth thinking about, wait, what, not because we're saying good or bad or right or wrong or change they should make, but it's a good idea to know in a descriptive setting, what is their capital structure? What is the percent of debt? And it's usually good to look at this as a percent of something else. That's why we have debt to assets. What of their assets, what percent is financed by debt? Really the same thing with debt to equity. What are the two main forms of financing? Not the only forms, but the two main ones, debt and equity. So again, we're looking at debt in proportion to equity. Here, the equity would be our total stockholders' equity on the balance sheet. And that's one way of looking at what is my debt, not just in isolation, not the dollar amount, but in proportion to the other common form of financing, stockholders' equity, or in proportion to my total assets. So different ways of looking at my capital structure. And the last one I left is financial leverage. There is not actually just one and only one way to look at financial leverage. So before, I'm not trying to beat in your head a bunch of calculations. I just want to offer this idea. When you're thinking about this, financial leverage, the concept, calculated differently, but no matter what, we're trying to figure out to what extent are we using debt so that if we're successful operations, debt can be used to magnify the return that our shareholders get. So that's the general idea of financial leverage. The leverage in the physics sense is that, okay, if I have profitable operations and I have a proportion of debt, I can actually magnify the returns that my shareholders get. To be absolutely clear here, though, it works the other way too. And the biggest caveat is you have to have profitable core operations. If you don't have profitable core operations, taking on more debt may make your situation worse, may bring you to bankruptcy quicker, may cause greater problems. So the leverage is there's drawbacks to this in different ways, but it only value enhancing is if your core business is working out well. It would actually have the offsetting negative effect if your core business was poor. So again, different ways of assessing capital structure. One of the things we want to think about is, are we using financial leverage? Generally speaking, we talk about that as the choice to use debt to enhance profitable operations, with the huge caveat that the operations have to be profitable from the perspective of our shareholders. Which brings me to my last set. I'm going to wrap all this up. Different measures of actually bringing all this stuff together. We can look at return on something. So I have three classic ones, not the only ones. There's obviously more adjustments and everything out here, but let's talk about these. Return on assets. Without getting into what we put in the numerator, it's generally speaking like a version of income or profits with some changes needed at times, divided by our total assets on the denominator. What does that tell us? Well, how well do we do at generating income from using our assets? And that's just, we could argue that's an efficiency metric. How well do we generate income with the assets we have at our disposal? And in most cases, higher is better, but there is exceptions to that. Return on common equity. Here, we were going to put net income in our numerator, and we're going to change the denominator to be just our average total equity. So that's saying how much income, which is profitability from the perspective of shareholders, is generated in proportion to the amount of equity we have, book equity we have in the company. So that one is not about the total business, like return on assets. It's just the return from the perspective of shareholders. are providers of equity capital. And finally, the return on invested capital would be slightly different than both of them. In the denominator, we would have our equity, but we would almost surely have all of our invested capital. So it would include things like debt or interest-bearing obligations. And the denominator would be, hey, everybody who contributed capital to our company is put in the denominator. And then in our numerator, we look at the returns. That would likely not be net income, which is just the perspective of shareholders. It'd be more of a version of operating income, but again, some adjustments can be made there. How well did we as a business return cash, create wealth, earn income, earn profits from the perspective of all of the capital put in? So it's like debt and equity in the denominator, and then some degree of profitability in the numerator. Much more to go on all these. I just want to talk about them all. Just to wrap this up, we care about understanding liquidity. Certainly, if we're worried about the company paying its bills, think of different ways of assessing that. At the basic line, you want to look at what's on the balance sheet, what's their cash flows, what are their obligations, what are their expenses, and still, in many ways, we're still going to get back to net income. What's your long-run solvency? Revenue minus expenses is a positive number day in and day out. If that's true, you're likely not going to have problems with liquidity. You're going to probably have a good way of working out kind of across all these dimensions and all these ratios. But liquidity matters if you want to understand short-term performance. You want to think about understanding capital structure. So looking at the proportion or the type of financing. And then at the end of the day, certainly once the company is established, we care about the return they're generating. But there's not only one way to generate a return. First, we want to think about in proportion to what? Assets, equity, total invested capital, and then make some adjustments to look at, okay, what's our profitability with respect to each of those. So much more to go on these. Just wanted to introduce these ratios. Hope this is helpful. Take care.